Good morning, everyone. I say good morning because it is 9:42 New York time as I do the 7:42 here in Costa Rica where I am. And I was listening to BBC News, the live stream on YouTube for the last hour, and nothing in that region has changed. So we're going into Sunday night, so far from where we stand now. Early Sunday morning, this thing moves very quickly, but nothing has changed. And when nothing has changed in this particular situation, it actually only gets worse, just because of the nature of how energy is pulled out of the ground and how it is shipped. You can't just turn off the switches. That means that bringing it back online takes that much longer. So to avoid the worst of the worst, this thing needs a resolution like this week sometime. The longer this goes on, actually, the worse it becomes. I'll have more to say about that a little later on, but I'm not going to give you a history lesson over the last week. Everybody knows where we've been, where we are. Just a matter of where we're going and what it means. Let's have a look at the last week. Was not a good week in duration. Look at that. The long end of the curve going higher. Even money market rates squeezing in 2, 3, 4 basis points here and there. So from year to date, everything on that curve is higher. So any short-term rates you have, any debt you have that's tied to short-term rates, that's tied to the 2, the 5, the 10, the 30, all of that, all of your debt has become more expensive, along with food, along with energy, making America great again. Dollar was the big story for the week. Look at that, up 2%. Threatening to break 100. If this continues on, you could see the dollar break 100 this week, and that puts downward pressure on commodity prices, except for energy. Our slopes for the year, the 3-month to 10-year, actually has increased 10 basis points, but are 2 to the 10 flatter. Have a look at our performers this year. XLU, the number one performer, the utility sector. Our number 2 performer, XLP, had a bad week last week, but still, year to date, up almost 10%, and you got a 2.5% dividend yield. Go right to the worst performer, Triple Q. Second worst performer, at least for the ones I have here, SPY and TLT. Look at this, beating out the equity indexes, but last week did turn negative, down 2.17%. Ugly sell-off on TLT. That's the reason why. Long end of the curve saying, we don't like any of this stuff. What I find interesting is the one-sided approach that the market is taking towards duration is they're pricing in inflation. But we've seen the jobs report say there are no jobs. Jobs are disappearing. We've gotten the GDP report last week saying that growth you thought you had in Q4, cut that in half. So growth is very low, jobs are disappearing, but the market is not pricing in a slowing economy, which is always disinflationary. It's just pricing in one side of the equation. Oil prices going up, that's inflationary. End of story, period. Don't talk to me anymore. ZQ had a bad week. My position, I'm down, I think, about $980,000 on that one position on ZQ that I have. But I did bring myself back up to 600 contracts. I am not budging. I am not moving. So I'll have a story to tell when this is all over, no matter which way it goes. Stay tuned. KRE, look at that, down 2.77%. It is negative for the year. So if it doesn't change, its loss for the year equals its yield. It's gone nowhere, but it's got some problems, right? The market has priced out rate cuts. That is negative for KRE because its funding cost is tied to the short rate, the 1 month to the 3 month rate. So if that funding cost is not going to go down, if that curve is not going to steepen, well, prospects are minimal for the upside. More private credit concerns. And it's starting to talk now about the exposure that banks have, because banks lend private credit funds money. Private credit funds lever up, and they lend it to companies who are already levered up. So you got a lot of leverage through the system. How much exposure do banks have? Not just to private credit, but how much of the bad private credit? Well, that is a negative for banks. You had a steeper yield curve, the 3-month to the 10-year. You had a steeper yield curve. It should be positive, but there we are. I'm sure in the background you hear that cicada that has decided to show up and say, oh, you're doing a video. Oh, let me help out. ZQ. This sort of was the worst of it here. 22 basis points for the whole year, based on the futures, the structure of the futures rates. 22 basis, not even a rate cut, and this is going out to and using the January 2027 ZQ, because there is no meeting in January, so it's a nice. There is a meeting, but it's later in the month, so January ends up being a nice clean month to use, because it's the average of the whole month. That means not quite a rate cut in 7 more meetings. Okay, the 2 with Powell, yeah, this Fed's not going to move. Everything we know about this Fed and the way they've reacted around things, they're not moving. They're not raising rates. I don't see that. This I think they're all at least smart enough to say, look, this could be a temporary increase in the price of oil. We're not going to raise rates yet, but we're data dependent and we're watching, and I think that's where it's going to be. But now's not the time to cut rates. And then you have Warsh coming in. And I spend some time on this because I really want you to understand the change in focus, and thinking that, well, you're never going to get a rate cut out of Warsh, not with this inflationary pressure showing up. And it comes down to, well, what do you think causes inflation? Are you Keynesian or are you monetarist? Is it too much demand, chasing too little supply, that causes inflation? Or is it the increase in the money supply that causes inflation? Depending on which way you think, you may change your mind about what has the right effect. If you go all the way out to May of 2027, that is 10 meetings away. 24 basis points, still not a full cut. All the way out to May of 2027. Now, if oil prices go higher and this continues on, it would not surprise me if you get 0 in this curve, or even a rate cut, a rate hike, or even 2 rate hikes. That would be stupid, but sometimes it's hard to figure out how stupid can be. The idea that the market is completely ignoring the change in the Fed chair that's coming up, to me, is shocking. Speaking of that, this week, a judge threw out that case against Powell. Judges have thrown out cases the administration has brought before. Letitia James, James Comey, throw them out. This one, they threw them out as well. And it looks like it's going to be difficult to get Warsh confirmed with this thing hanging over Powell. So you think, well, the administration has to find a way out if they want to get their candidate through. If they really want lower rates, they're going to want to get their candidate through. That's the win, not with 2 meetings left in Powell trying to twist his arm to get a rate cut in the next 2 meetings. So you had a win. But the administration, in true administration form, pulled the gun out of their holster, aimed it at their foot, and fired. And we're going to reopen this. We're going to not stop. We're going to continue going. We're going to appeal this whole thing, but we're not letting this go. You had the win, and you just shot yourself in the foot. The door was wide open to simply just blame the radical, lunatic, left-leaning judge, blame the activist judge, call them all the names in the world, tell all the American people, look how deep the corruption goes, the left is really deep in the deep state, and start raising election. You could have done all of that, all the stuff you do, Take the win, push your candidate through, and get the lower rates and take that win as well. But no, gotta take that gun out, pull the trigger, and shoot yourself in the foot, all the while screaming that you're the victim. So here we are again. Tom Tillis is still saying, you can't have my vote, and it's looking questionable, and it's, oh, God, all I can do when I see stuff like that is I just hang my head and I think, oh, God, I cannot win for being right. GDP growth slowing down significantly. Jobs are disappearing. You had the way clear to bring Warsh in, and you mess it up. It is hard to hold a position on some future that you need this administration to bring about. It is just so hard to do that because they seem to be their own worst enemy. I just want you to put something in your head for a minute. What if, and this is just a what if, but ask yourself if the data fits. What if Trump's goal is not to make America great again? What if his goal is to destroy America, to get everyone back for not backing him in 2020? What would you expect to see if his job was to destroy America? It would be like, well, why don't you just make the debt really, really worse? Like, just make it bad. Let's isolate ourselves from the rest of the world. Let's piss off all our friends. Let's raise prices for all Americans. Let's raise their energy prices. Let's raise their food prices. And let's get them involved in another forever war in the Middle East and really destroy the amount of debt that they have. You would look at all of this and you'd say, I got to give this guy an A+. A++. Look at the execution. The only way you can tell me that this guy is a genius is if his strategy was to destroy America. Then you'd say, no, this guy is a genius. Look at the game he's playing. He's playing 5-6 moves ahead. But if you think that he is trying to make America great again, you have to come to the conclusion that you've probably never seen such worse execution in your life. If, and I use the word if, let's think about it in terms that we can all understand. If this was a company with this level of debt and this type of management, it would be a screaming short. Management just can't seem to get out of its own way. Management can't execute on any plan. They don't even recognize the problems they have, so they're not going to fix it. One of the things I say when you're looking at stocks that are hitting 52-week lows, some of them are great buys. But you first have to say, okay, well, they're hitting a 52-week low because there's a problem somewhere, right? Does management recognize it has a problem? If it does, that's the beginning of a turnaround. Is the recognition that it has a problem. Does management, if we think of the U.S. as a company, does management recognize it has a problem? No, it does not. Is management the problem, or is it just a bad environment? For example, Blockbuster Video. Management wasn't the problem. That business was going to die anyways. No matter what management you would have brought in, it would have been difficult to save that business. So here we ask, is management the problem or is it the environment? No, management is the problem and management doesn't recognize that it has a problem. Those two are the worst things. That is a screaming short. All you can do is sell at that point. But a country is not a company, and I've pushed back on that analogy before, but it helps us think about it in terms of the effectiveness of management and the direction of the country. We have an ineffective team. If we take them at their word that they're there to make America great again, I don't know that you could have worse execution. But if we accept that, well, maybe he's just getting everybody back for not backing him, then I gotta say, this guy's brilliant and I wouldn't want to play chess against him. Okay, I wish I had some good news for you on this screen, but there isn't. Real rates all higher. A stronger U.S. dollar and higher real rates are negative for commodities, especially gold. Gold down 3% for the week, still up 16% for the year. Break-evens, all a little bit higher, but not so much that you would say, I'm surprised they're only up that much, given all the inflation talk we've had all week long, all of it. Anything else that argued against it, like a drop in demand because of lower employment, a drop in demand because of lower GDP, that got no airtime. Inflation. You had some commentators on Bloomberg editorializing, well, they're going to have to raise rates at the next meeting, aren't they? Almost cheerleading a rate increase. It's like, oh, God, guys, come on. Year to date, though, not too bad on the 5, the 7, and the 10-year real rates. And credit also starting to feel the jitters from the private credit side. All the credit spreads have widened, except the riskiest. It's like, well, let's put a bit more spread into investment grade, especially the AA and the BBB, and high yield, maybe not as much as investment grade, but let's buy up the really low-end stuff, given that we have all of this private credit fear. Let's go into CCC. Sometimes there's no rhyme and reason for what the market does. You look at this and you think, but I don't understand. Why would you widen spreads on investment grade, but then go all the way to the bottom of the credit structure with all the private credit fears and say, no, tighter spreads, tighter. Well, let's pay more for this stuff, but there you are. Year to date, all spreads have widened, which is something we didn't see through 2025. 2025 was just tight spreads, and no matter what was going on in the world, those spreads didn't budge. The most common expression I had when we got to OAS is nothing to see here, folks, but little something to see here. Mortgage REITs did not have a good week at all. 2.5% down on Annaly, almost 4% down on agency. They are negative year to date, and your mortgage rate, higher levels of mortgage rates. You have much more volatility in the spread and wider spreads. So many of these, well, not many, the two that I have listed, both of them have actually decreased their hedge ratio on duration, which means they do have some positive duration exposure. Last week was not a good week in duration for them, under-hedged on the interest rate risk, which to me made sense to do. I probably would have made that same move. And of course it was wrong. And wider spread, the higher that 10-year goes, the wider the spread becomes. Not a good week for mortgage REITs. Still, I think that mortgage REITs are going to be the winner this year. Another good 20-30% return this year like last year. Look at your metals. A much stronger dollar is not helpful for metal pricing at all. And higher real yields are not helpful, and it shows. Gold down 2.6, silver big loser here, 4.35, copper in line with gold and pulling back 2.43. I added to my copper position. Platinum and palladium down almost 5.5%. Aluminum, the only one that is up, but aluminum is hugely energy intensive to make. So the higher the energy prices go, the higher the price of aluminum will get. 15.5% year to date. Aluminum just below gold at the beginning of the year. If I said, you want aluminum or do you want gold? You said aluminum. Give me a break. I'll go into gold. Well, guess what? Aluminum is in second place on that final victory lap. Look at that, 15.5. This is the story here. Once you get to energy, 71% on West Texas. That is for delivery in Cushing, Oklahoma. Almost everything sells at a discount to that. It's not as if an energy producer gets $71 a barrel. It sells at a discount. If you're producing in the Permian Basin, you have the quality of West Texas. You have so there won't be quality differential, but you have to deliver it to Oklahoma. So it is going to sell at its Permian Basin pricing, which is lower than where the benchmark happens to be, and that's why it's called a benchmark, because everything is priced relative to the benchmark. It's not that is the price of oil, that is the benchmark upon which all other grades and locations are set. Still though, 71%. Nat gas down for the week, down 0.95, down 15% for the year, but we're not in heating season anymore, so it really doesn't affect too many people, or we're slowly moving out of heating season, but we're moving into the spring and then the summer coming up into the driving season. That is a killer right there, 71%. The higher energy prices means it's much more expensive to run your machinery on a farm, but worse than that is the fertilizer, the input for fertilizer. A lot of it comes through the Strait of Hormuz, which means the thinking is less fertilizer being used, lower yields per acre, lower yields, less supply than demand. It's going to push the price up, and boy, has it ever. Wheat is up 22% year to date. Now, imagine if I said at the beginning of the year, hey, listen, you can buy wheat futures or you can buy gold futures. What do you want? I don't think anybody out there had wheat listed as, oh, no, I'll take wheat. Absolutely, it's going to kill this year. Look at that, 21%. Soy, 16.5%, beating gold. Even corn coming along for the ride, up 3% year to date. Hogs and live cattle pull back. Why? Because you've got soy and corn that are going up in price. That is the feed for these things. So when these things go up in price, these things go down in price. There you go. Still up almost 10% year to date. So wheat, corn, soy, pork, beef, more expensive today than it was on January 1st. Energy, way more expensive than it was on January 1st. Interest rates across the curve higher than they were on January 1st. This does not sound like you're winning the affordability argument. And let me put a weighting on that. W and W1. Weighting is the election. W1 is not the election. You have a less than 100% probability that you have midterms. I say less than 100% because I still put about a 10, maybe 20% probability that, maybe they're canceled. I mean, if this thing in Iran continues on, you have grounds to say, folks, now's not the time to change things. Now's the time to hold the course. If we lose Congress, these Democrats, they hate America. They will stop funding this war, and Iran will bomb us at their own will, and we won't be able to defend ourselves, folks. Now's not the time. Let's finish this war and we'll get back to elections. I still put about a 10 or 20% probability on that. So you have a weighted probability of midterms this fall, of which I put almost 100% probability that the Republicans will lose Congress. The Senate, that's a coin toss, but they'll lose Congress on this one. March 18th. Which is in 3 days. We have Powell, which I think this chart is right, 99%. Not because I would agree with it, but it's a Powell Fed making the decision. They're not going anywhere. They're not going anywhere. And you get the summary of economic projections. I don't think they're going to mean anything. Powell's last stand, the April meeting, 95% probability that he's not going anywhere. So 0.991 times 0.95, you're basically running about a 95% probability that Powell's not cutting. And barring anything that breaks the system. Now, when we say he's not cutting, if you get a bank this week that says, oh, we're in trouble, and a couple of banks have to go to the Fed because of private credit on their balance sheet, and you get a private credit fund that blows up, and you get a pullback in credit in a lot of places, you might get a cut in April because of that. If you get a quick resolution to this issue in Iran and the private credit thing is worse than expected, you might get something there. Yeah, but I think the market has that right, not based on the fundamentals, but based on Powell, that there's probably 5 or 6% probability of a rate cut. Yeah, I would agree with that. What I don't agree with is Warsh's first meeting. At least one cut is down to 23% from 46%. Cut in half. I guess we have to ask ourselves, what is the probability of Warsh's first meeting, not what is the probability of what they'll do, but what's the probability that the first meeting will be with Warsh. Again, the administration, self-inflicted wound on last week. They had the win. They could have advanced their candidate and had the confirmation hearings and begin to change the narrative on what the Fed is going to do and where the Fed is going to go. Begin to change that narrative. The market would have started pricing that in, but decided to no, let's not take the win. Reverse repo. Last week hit the lowest level, 137 million. It's sitting at 427 million. Repos are zero. SOFR well behaved at 3.65. Reserves still sitting at $3 trillion. And the TGA at 805 billion. I'm going to make the case shortly that the new guy coming in sees this as the problem, not the interest rate. This is the inflationary mechanism, is the level of the balance sheet, and not this. And one of the commentators on Bloomberg said it without saying it. Said it's been 5 years now that we've had elevated inflation. You know, the Fed really, and it's still sitting 50% above their target at 3%. And it's not 3%, it's lower, but when you're editorializing, you try to make it sound as incredible as possible. And it hasn't been working. Well, exactly. It hasn't been working. So maybe the interest rate is just not the thing. Maybe the interest rate doesn't work. And I've made this claim before that I think that we live in a world that is so financially sophisticated now that the interest rate really, that so many different places are immune from rising interest rates. Much of the economy is immune from it. Warsh makes a different statement. He says the center of inflation is not the interest rate, it's the balance sheet. Let's look at the housing. Existing home sales for February up 1.7% month over month. That's good. Mortgage apps for March 6 up 3.2%, but that was a 6% 30-year. Let's see what it is now that we have a 6.11. Housing starts, this is only for January, up 7.2% month to month. So showing some life over here, but this will kill it very, very quickly. So you've got to get the long end of that curve down. Here is a chart of January 2027 ZQ. And on, I should say this is February 27th, but February 28th, 9708, implying a rate of 2.92 by the end of the year, which is a little more than 2 rate cuts. And 10 trading days later, the implied rate is 3.415, implying maybe one cut, but not entirely, but maybe one cut. ZQ lost almost 50 basis points in 10 trading days because the focus of ZQ is on a Powell Fed. But ZQ is sort of blind in this sense, and I think the market is completely wrong because it is pricing in a Powell Fed all the way to the end of the year. That you're going to have continuity in the Fed, even if you have a new Fed chair. And I want to sort of impress upon you how very different it's going to be, because the question, quite rightfully, has come up. If he's one vote, how's he going to get this done? And he's not really one vote. He has people already on the FOMC that would agree to a rate cut. But what about all the others? Well, you do have to give them permission to cut. And you can't have a Fed where suddenly you're not getting any rate cuts, but the chairman is dissenting. And then the next meeting you're not getting any rate cuts, but the chairman is dissenting. You cannot have that. That's just not going to be very, very constructive or useful at all as a Fed, and that'll bring into question the usefulness of the Fed at all. So you got to get everybody on board. Here's the difference. The Powell Fed believes the interest rate is sacrosanct. The interest rate is what you control to bring your targets into alignment. So if you have your interest rate here and inflation risks rise, you would raise your interest rate And this works on the level of demand. So what you're going to do is you raise the interest rate so that you end up with a situation where demand is less than supply or that equals supply, because your belief of inflation is demand is greater than supply. It works on the demand side. It does not work on the supply side. So that if you have a supply shock, not a demand shock, but a supply shock, raising the interest rates will not change the level of supply. And when you have a supply shock in a key input like energy, where most people don't have much of a choice, we have little choices that we can make about where to drive, when to drive, how far to drive. Maybe we're not going to take the vehicle out just to go pick up one thing at the store. Maybe we'll wait. We do have some discretion, but not a lot. That trying to destroy demand on something like that isn't going to be very effective. So you say, well, if we raise the interest rate, and here are the sectors of the economy, and this one here is immune to the interest rate, let's destroy demand in some of the other ones such that the average of this price level begins to drop. The end result is it works on the side of demand. You must bring demand down. Well, bringing demand down means that people aren't taking their money out of their pocket and giving it to someone else. That means somebody else isn't receiving that income. That means you want to slow down economic growth. You want to slow down economic activity. And that's what they believe. And if you believe that that is how it works, that the mechanism to controlling inflation is the interest rate, you are a Powell Fedist. That's what we'll call you, a Powell Fedist. You are data dependent. The data will tell me. Let's look at the data on inflation. Let's look at the data on economic activity, basically full employment. And we're going to try to balance these things out so that they're in balance. You are very Taylor rule dependent in that sense. You're looking at balance of risks, and you're operating in an ample reserves regime. Because, of course, you're not a monetarist. So you don't think the size of your balance sheet has anything to do with inflation. You believe it's all the interest rate. And you've had a head of the Fed for 8 years dictating that, telling you that, getting consensus around that. Everyone is sitting in a drum circle around the interest rate. And when they see inflation, well, the interest rate's got to go up, right? And inflation's coming down. Well, we haven't got enough data. It's coming in the right direction, but it's not at our target. You see lower employment, you see lower economic activity, or the balance of risks have shifted, but inflation is uncomfortably high. We recognize the toll inflation takes on families in America. We're firm. We remain firmly focused on our dual mandate of full employment and inflation, the balance, blah, 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 interest rate, interest rate, interest rate. If you believe that, then you agree. Then you would look at that forward curve and you'd go, no, that is the right thing to do. This is going to be inflationary. There's going to be no cuts or even interest rate raises. But remember now, it works on demand. We have energy prices going up. Is that because demand around the world is skyrocketing? That everyone suddenly is demanding more oil and more energy and more gasoline and more jet fuel? Or do you have a supply problem? If you have a supply problem, the interest rate does not work on the supply problem at all. I make this point in the level 3 CFA economics videos, that the CFA textbooks assume at all times that inflation is demand driven. So everything we read at level 3 about the tools that are used to fight inflation is assuming that inflation is demand driven. So all the curves that you draw about how the price level comes down as the interest rate goes up assumes that it works on demand and that demand is the problem. But when supply is the problem, it doesn't work. And CFA textbooks don't go into any kind of detail at all. They just make a mention that if it's supply, it's a different story. Demand-driven inflation is assumed. Let's go over to Warsh. Let's say that you don't agree with that. You're more of a monetarist. Warsh believes the balance sheet is the mechanism that you would use to either create or get rid of inflation. So again, there's our interest rate, and you see prices. So not the interest rate. Sorry. Here's our balance sheet, and we see inflation increasing. Or should say, decrease the balance sheet. Remove reserves. Remove liquidity from the market. What you have is too much money in the system. You need to remove money, not the level of demand, it's the level of money in the system that you have to remove. Too much money chasing too few goods and services will push the price up. And let's get out of a ample reserves regime into a scarce reserves regime. So remove money supply, let the economy work. Technology is disinflationary on its own. You don't need the balance sheet. But let's say that you had a period of deflation, which is very bad. A period of deflation. Powell would lower the interest rate to 0. Whereas a monetarist would say, well, we need to add liquidity to the system. The balance sheet does the work when it comes to inflation. The balance sheet is at the center of it, not the interest rate. Now, I want to sort of give you something to think about, and you can go look at the data if you feel like doing a bigger dive on this, and I think it's the basis of a good paper. After 2022, you had inflation that just spiked, and then inflation started coming down, and now it's kind of doing this. I'm going to draw another chart right below it, and this will be what the balance sheet is doing. Is you had, and this will be runoff, so this is negative actually. Actually, I don't even need to do that. Let's do this. We'll just extend this one here, and we'll put this as negative because it's balance sheet runoff. So you had, it wasn't until 2022 when they started to end adding to the balance sheet, and they started the runoff on the balance sheet. And as they started the runoff on the balance sheet, here's what you got. This is runoff on the balance sheet. And then as time went on, what they did is they said, okay, let's slow down the running of the balance sheet, and now let's start adding to the balance sheet. Well, you had inflation come down and go sideways. You had the balance sheet runoff slowing down and then added to. During the period of time, if you go back and look at when they started adding to the balance sheet, is when you started to get stickier and stickier inflation. That makes the case over here for Warsh. Inflation came down as they raised the interest rate, but let's keep in mind they were also allowing balance sheet runoff at the tune of $65 billion a month, and inflation came down. Then they slowed down the runoff of the balance sheet and started talking about sticky components of inflation. Then they started adding to the balance sheet. The $15 billion in MBS that rolls off every month is being rolled into treasuries along with another $5 billion, so they're increasing the balance sheet at $20 billion per month, and suddenly, inflation is sticky. In fact, we're expecting inflation to be a little bit higher this month. Seems to be related a lot to the balance sheet. So what do you believe? Do you believe that the interest rate is the center of the inflation universe, and you can just ratchet it up and ratchet it down to affect inflation? Remember now, that is, the interest rate works on the side of demand. Or do you believe it's money? If you start printing dollar bill after dollar bill after dollar bill, you're going to create inflation. If you want to remove inflation, remove liquidity out of the system. The balance sheet becomes the center of your universe, not the interest rate. That is Warsh. Why the market has not come to accept that this will be the reality going now under this regime, just to be clear, under this regime versus this regime, if you were a FOMC member under this regime where you were told the interest rate is the center of the universe, we have inflation, your Taylor rule would tell you the interest rate has to go up. But if you're on the FOMC committee and you're told, no, it's not the interest rate. The balance sheet is the source of inflation, and we see inflation going up, you'd say, well, we have to reduce the balance sheet. A smaller balance sheet can live with a lower interest rate. And that is Warsh's thesis, is you bring down that balance sheet, you can lower that interest rate, you can steepen that yield curve. There's the 10, there's the 3-month. And if you steepen that yield curve, if you're running off the balance sheet, you need a new buyer. Well, who's going to be your buyer? Give the banks a steep yield curve. They use leverage. So if you give them 150 basis points between the 3-month and the 10-year, and they use leverage, They will be the buyers of government debt, which is what banks are in the business of doing, lending money. They just lend it to the government. They'll be the buyers of debt. The Fed doesn't have to be. We had our second look at the U.S. Q4 GDP last week, and it came down a lot. Big drop down to 0.7, and actually, if you calculate it out, it's 0.65. Consumer spending lower, investment lower, government spending lower, which is kind of a good thing. At least you hope that the lower government spending translates into smaller deficits, which then translate into a slower growth in the debt. You hope that that's the case, and you hope it doesn't end up being, hey, look, we saved money over here so we can spend more over here, which is more likely the case, right? Exports, real drop in exports. And imports, you had a slight drop in imports. The components break down as follows. Consumption was 1.33 of the 0.65, investment 0.57, government and trade balance taking it away, negative 1.03 on government contribution, the contribution of the G component to GDP, and negative 0.22 on your trade balance. I've done some numbers here for 2025 because over the course of 2025, Q1, Q2, Q3, Q4, you have all of these wild numbers. Let's just, now that we have the whole year, we can look at growth year over year. Real GDP for all of 2025 was 2.117, a far cry from the 3% that Besant is calling for, or the 4 to 5% that they've been touting as the growth rate of the economy. 2.117 nominal. These are just in dollar terms, not controlling for inflation. This is price times quantity. This is P times Q. This is just Q. This is quantity holding price constant, up 5.014%. This is interesting. If we look at what 2024 nominal GDP was, it was $29.298 trillion. In 2025, nominal GDP was $30.767 trillion. That should be a T. Which means that through 2025, the economy was $1.1691 trillion bigger. However, you had a federal deficit of $1.7 trillion. So the $1.7 trillion deficit couldn't even add $1.7 trillion. Had you balanced the budget in 2025, had you balanced the budget, you would have had 2025 nominal GDP for the year coming in lower than 2024. That means you're in a private economy recession through all of 2024. You were in a private economy recession. Total economy, you had growth. Growth that was paid for by a government deficit. 2025 consumer credit increased 2.4%. Revolving was 3.4%. Non-revolving 2%. That is your mortgage, your car loans, things like that. Revolving is your credit card. 3.4%. Q3 got even worse. Q4, 3% growth in consumer credit, and December alone was 5.7% growth in consumer credit just in that month versus the year before. So all of this is just based on year over year. So a lot of that growth, that 2.4, came in the fourth quarter, came at the end of the year. This is what is directly affected by the level of the interest rate. So for these households, their energy costs are higher, their food costs are higher, and why stop there? With this Fed, their interest costs will be higher as well, because why should they get a break anywhere? This is sort of where we are. Personal incomes throughout the year rose 4.87%. Now here's an important point. This is not inflation. So we can look at the price level and say, well, the price level is higher. we have inflation. I would say, hold on a second, that you're looking at only one part of the equation. Inflation is when I'm working and I can't afford the same things, that I'm actually buying less and less and less stuff for every hour that I spend. But let's say that I think about it in terms of loaves of bread, and I put in 1 hour, and from 1 hour of work I can buy 4 loaves of bread. Inflation is when I can only buy 3.8, when I can only buy 3.6. But what if I can buy 4.2 even as the price of bread goes up? What if I could buy 4.4 even as the price of bread goes up? Then that's not inflation, that's deflation. It is based on how much you make, not just the price level, because the price level also has a corollary to that, which is called the wage level. Now, if the wage level is rising faster than the price level, as far as the average consumer is concerned, that is deflation, because an hour of their time ends up buying more stuff, because an hour of their time got more valuable than the stuff that they're buying. Personal income's up 4.87%. Real GDP was 2.117. Nominal GDP was about a little over 5%. So in there, you've got about 2.9%. The difference between, if this is just quantity and this is price times quantity, price must have made up the 2.9 of quantities, the 2.11. Take off 2.9% off of your personal incomes. Real incomes increased by 2%. In other words, the affordability in the economy, and we can only speak about the average, right? This is what we're doing with aggregates, is we aggregate everything up to an average. Some of you out there may be saying that's not my experience. I would then say, well, then there's something that you're not doing to raise the value of 1 hour of your labor. If you can't raise the value of your labor by 3, 4, 5% a year, you're missing the point. You're waiting for society to come and hand you something. You have all the power in the world to raise the value of your labor. Personal income's up 4.87%. Prices up 2.9%. Affordability increased by 2%. That is real wages are positive. Now, if real wages are positive, it doesn't matter if the price of something doubles if your wage triples. It still becomes cheaper for you to buy. So again, the price of bread could go up, but the value of 1 hour of your labor could go up by more, thereby allowing you to buy more of the quantity. That is deflationary. So if we look at inflation as only the price level and we ignore the wage level, and you just look at the price level, you would think, oh my God, look at the price. We've got to make debt more expensive for everybody. Everyone's got to pay more interest expense on all of their debt because the price level is going up. But if real wages are going up faster, then it's not. This is the same argument with productivity, is that you could have wages that are rising. But if your output is rising faster than your wages for the company involved, their average unit costs are dropping. So if you want to be worth more as an employee, you become more productive. If you're more productive, the company says, well, they're actually kind of cheap to have. Even if we paid them more, they'd still be cheaper to have because their output is so high. You cannot talk about inflation without talking about wage inflation as well. And if wage inflation is rising faster than the price level, that is not a problem you want to solve. If you raise the interest rate, you have to, that works on demand. You lower demand. If you lower demand, you create unemployment. If you create unemployment, you take wage increases and you push wage increases down, thereby depressing real wages. There's the cause of your unaffordability. Come on. We can all see it here. And of course, look at this. Not only do we have GDP that has got marked down by more than half, you had a job loss in December. The economy lost jobs. And again, in February, they lost jobs. We're going to get another jobs report at the beginning of next month. We'll get revisions for January and February. All revisions have been negative, so expect that January number to come down a little bit more. Expect that February negative number to be even more negative. CPI, let's keep in mind, for February was lower. And if we go back to January and we get rid of all of the imputed prices, PCE was not 0.4. Market-based PCE, just on prices that you can see, was 0.27. Okay, let's have a look at PCE. The numbers here get a little bit more sobering. 81.1 billion increase in current dollar PCE in January reflects an increase of 105.7 billion in spending on services. That sounds like a lot, right? Partially offset by a decrease of almost 25 billion spending on goods. And this gives you a breakdown of the changes in monthly consumer spending, goods and services, and we can see goods all the way down here, and we see services at this upper level over here. Look at the first one, healthcare, 37.4%. So you got a lot of spending on services, but look at healthcare, 37.4% increase. Aging population, more healthcare spending. That is going to happen whether you have an expansion or a recession. That has got zero beta to it, and that is purely a function of rising demographics. So what I did is saying, well, let's see what the effect on jobs were over the course of 2025. So we had the February jobs report. I went back to it, and I looked at February 2025 over February 2024. And the first line in one of the tables is total jobs. Total jobs, you can look at seasonally adjusted or non-seasonally adjusted. 156,000 jobs were created. That is it. 156,000 jobs were created from February of 2024 to February 2025. That is year over year, seasonally adjusted, not seasonally adjusted, 129,000. Healthcare jobs, 363,000 were created in healthcare jobs. So just taking healthcare jobs and adjusting the amount of jobs over here, you actually had negative 200,000 jobs outside of healthcare. Just taking healthcare out, negative 200,000 jobs gone. And again, look at PCE. Look at the increase in healthcare spending month over month. The money is going into healthcare spending. That is what's driving services. And what is driving the economy are healthcare jobs. But that would happen no matter what the economy was. If you control for this maintenance capex, which I've been referring to healthcare jobs for a long time as maintenance capex, and you look at growth capex, there is no growth capex. Now, that's just healthcare. Let's add social assistance, because again, this is not a function of economic activity. Social assistance, seasonally adjusted, 316,000. So between the two of these, you're getting close to 700,000 jobs in healthcare and social assistance, but the economy added 156,000 last year. So well over 500,000 jobs were lost last year. Outside of healthcare and social assistance, well over 500,000 jobs were lost last year. Your services spending, 105.7 billion in spending on services, is dominated by healthcare. Next one is housing and utilities. Well, we've all got to live with housing and utilities. Utilities is a function of your energy costs. Higher interest rates aren't going to fix your energy costs. Higher interest rates are not really going to fix your housing costs. They actually make it worse by making your mortgage more expensive. And the housing costs within PCE are highly imputed. They're not market-based, they're highly imputed. Just take that into consideration when you're thinking about PCE, is just if you control for healthcare, the rest of the economy isn't doing that well. On the last screen, we talked about personal incomes. PCE 2.75, market-based PCE 2.7. Real wage growth last year was 2%. That means that every hour, on average, of the whole economy, the average per hour can buy more stuff in 2025, 2% more stuff. The same stuff can buy 2% more of it than they could in 2024. The real measure of inflation is not how much dollars something costs, but how much of your time something costs. Keep that in mind. That is the real measure of inflation, is how much of your time something costs. And last year, everything cost 2% less in 2025 over 2024 because of the wage increase. In fact, if you go back to 2017 and you look at real wages, they have grown 9.34% since 2017. That means in 2025, everybody could buy 9.34% more stuff with their time than they could have bought in 2017. Yes, it cost more in 2025, but you made more in 2025. So you must control for all of it. I'm beating this point to death, but this is one thing I just don't hear spoken about when we're talking about inflation. You have one side of the equation. Hey, prices are going up 10%. Yeah, but your wages have gone up 20%. What more do you want? Like more, you're actually better off now. Looking at some decimal points here from CPI, headline month over month was 0.267. Year over year, 2.414. Core, 0.216. Year over year, 2.457. The super core, 0.204. Year over year, 2.06. This removes housing, which removes the big imputed component, 2.06. And let's not forget tariffs. Here we're going to use Williams. He estimates that tariffs are adding about 0.5 to 0.7% to CPI. The St. Louis Fed pretty much falls into the same place. The Congressional Budget Office says that's probably about 0.4. It's adding about 0.4. So I say let's assume it's 0.3. Let's go even lower than what these guys think, the St. Louis Fed, the head of the New York Fed, the Congressional Budget Office. Let's go even lower and go 0.3, and let's adjust our numbers for 0.3. Headline came in at 2.114. Core came in at 2.157. Super core at 1.76, and this is taking out the imputed price. Keeping in mind, of course, that if you remove healthcare and social assistance, the economy lost 500,000 jobs last year, and of this services spending, look at healthcare over here, and let's keep in mind real wages. Does this sound like a problem that needs to be fixed? Does this sound like a problem where we have to say, let's raise the interest rate, let's make sure we lower demand, there'll be some job losses for that, we'll create slack in the economy so that wage pressure is even lower. Raising the interest rate would worsen your affordability situation, not improve it. I think we can all obviously see that. It would worsen it not just by raising your interest costs that you pay, but by pushing down the very driver that makes you beat inflation, which is wage inflation. It does not matter if prices are going up as long as your wages are going up by faster. Every year you face deflation in the economy. Everything is getting cheaper based on how much you're taking home. Look at all of these numbers here. Just take a moment on the screen and just go through them and just let it sink in, and then now switch your thinking over to, well, what if it's the balance sheet that's causing all of this inflation and not the interest rate? Okay, let's take a little bit of time and look at the shape of the curve for oil delivery. I wasn't even going to do this, and somebody had sent me an email saying, I forget if it was an email or a message on Discord, saying everyone's talking about the behavioral component of the futures curve. Can you talk about it? And what I say about most futures curves is they are not predictions of future price. They are a mathematical relationship between the components of the cost of carry. And this is true very broadly, except for commodities. Commodities have a slight little problem in there because they have something called a convenience yield. Well, we can't really see the convenience yield. We can make the case of what the convenience yield is. If you have a very tight spot market, it is more convenient to hold inventories than not to hold inventories. When you have a curve that's in contango and not backwardation, it makes sense to store oil to carry to a future period and sell it in a future period, but not if you have tight supplies, it makes more sense to say, look, I better have inventory, because if I run out, that's pretty inconvenient. So there's a convenience yield in tight spot markets. That is sort of implied. So you could make the case that, well, maybe it is the market's prediction of what the future price would be based on how convenient the market thinks it is to hold inventory as opposed to store inventory. What I have on the chart here, this is a term structure of the futures curve. This goes out for almost 10 years in the structure, and you can see at some point the curves are really pretty much the same. The yellow dots are Friday. This is as of when it says today the last price, that would be Friday. And then I took just 3 weeks ago. Let's just go back to before the stresses showed up in the curve. You had slight backwardation for about the first 12 months, and then you pretty much had a flat curve sitting in between 60 and 65 bucks out for the next 10 years. Now, I don't think that 10 years from now is any kind of forecast of anything. It is simply just a mathematical function. That is all based on what the forward curve is going to look like, based on what the time to expiration is, based on what the current spot price is. We can pretty much look up what storage costs are going to be at Cushing, Oklahoma, and then we make some assessment about how well supplied the market is to get some kind of convenience yield in there. You got a flattish curve. We have right now not just backwardation, this is called extreme backwardation, where it simply just drops off considerably. This bottom chart is the price differential between this point here and what it was 3 weeks ago. So it just gives you an idea of the price of the curve. Because we have extreme backwardation, that is implying a tight spot market, but because it's backwardation, comma, for now. A tight spot market for now. And if you're wondering how these curves come into play, let me draw out a curve in backwardation for you. Typically, you'd have a spot price, and then you'd have a curve that looks like this, because we make the assumption in a well-supplied market that the interest rate and the cost of storage will have a futures price that is higher and higher each month, because it is a function, just a mathematical function of borrowing money, buying the spot price, paying to put it in storage, and then selling it at some future date. If it didn't mathematically meet that, there'd be an arbitrage opportunity, which is why the curve is called a no arbitrage curve, or a no arbitrage price. There is no arbitrage in a curve, even with a convenience yield, but there is speculation based on how true you think that price is. Now, let's say that there's tightness in the spot market. This is what happens: is the spot price just skyrockets, and it pulls the front end of this curve up. And it pulls all the prices up, but not by the same amount. So you end up with a curve that looks like this. So that across the curve, all prices are higher, but really high at the front end. This is, whenever you see anything in backwardation, anything that looks like this, the market is saying the spot market is tight, but in the future, the spot market will not be tight. Because if they believe that this was not just cyclical but structural, as the price went up, this whole curve would move up and look like this and just keep doing that kind of thing. Well, you have extreme backwardation. This is the market saying the spot market is tight right now. Doesn't necessarily have to stay tight. Here is a strip from April of 2026 all the way to April of 2027, 13 contracts. You can see where the price settled. You could see that it was higher all across the board, but higher for front month. April of 2026 up 3.58. April of 2027 still up, but only 69 cents. So it's not as if there's no price pressure there. The whole curve moves up, but the front end really moves up. This is a list of what the prices were on February 27th. Look at the difference between April 26 and April 2027. You got 67.29 to 62.51, a little less than $5 spread. But now you're going from $99. Well, that's a terrible color on black. $99 all the way down to $71. You got about a $28 spread. The smart money plays the spread, but that's an impossible spread to play because the front month expires too soon. So you want to place some spread somewhere else. I'll give you an interesting spread. Here is the equation for the futures price. The futures price is a function of the current spot price, which is observable, multiplied, and we have e to the power of, and here the reason we're using e is because these are typically continuously compounded rates. If they're not, it would be 1 plus r minus q plus p to the power of t. You could simply just do it that way. That's probably the most common time value of money equation that you've seen, but this is just assuming that they're continuously compounded rates, so it is as an exponent to Euler's constant. R is SOFR for whatever time period it is. So if expiration is 30 days from now, we look at a 30-day SOFR rate. If it is 60 days from now, we look at a 60-day SOFR rate. That's observable. We can see that. You can observe the spot price. You can observe the interest rate. P, right at the very end, let's ignore Q for now, but P is your storage costs at Cushing, Oklahoma. That's kind of observable. You can figure out what the storage costs are. You can call them up and say, I'd like to store a barrel of oil for a month. How much is it going to cost me? And they might say, well, that'll cost you, 15 cents to store it for a month. But you can call them and figure it out. Q is the convenience yield, and notice that it reduces the exponent because there's a benefit for you having it. This is inferred from the futures price. So what we have is an observable spot price, an observable interest rate, an observable storage cost, and we have a price, a futures price in the market. And from this price, we could say, well, the convenience yield must be X. And that is where the behavioral component, you could say, comes in. The prediction comes in where commodities that have a convenience yield might import within it some prediction about what the future looks like, and that's what this is doing to some degree. You have a convenience yield. The money to be made in the energy market right now, the smart money to be made is not on the price. Let's just get rid of that. My trade workstation does that every now and then, decides, oh, we're going to close. The money is not to be made on the direction of the price, because you're either going to be right or wrong, and you got to get lucky, because you don't know how this thing is going to play out. I don't know if, as I'm doing this right now, if we have a solution, or if a major oil depot just blew up. I don't know. I don't want to take that chance. The real money to be made is a bet on the convenience yield. Is the convenience yield too high or too low at the back end of the curve? So you're going to basically ignore all of this stuff up here. You're going to say, I'm not even playing this, but let's go down here. Is there anything interesting here? And I'm not going to bet on the price. I'm going to bet on the convenience yield. I'm either going to say, no, it's probably in their best interest to hold it, and they should have held it when they had the chance, or it's not in their best interest to hold it. We will return to a well-supplied market. This convenience yield is too high. If you have the applied level, this is covered in the reading derivatives trading for the U.S. energy sector. I cover curve trades in here. This is a classic setup for a curve trade. In sector studies, you'll find it in the energy sector. That's if you have the applied analysis module. If you have applied asset management module, it's in the trading manuals, along with, I think there's metals in there. There's a livestock, there's grains, but look for trading sector for U.S. energy sector. Look for the section on CL, on energy futures, and it'll set up the curve trade for you. Have a look at the spread, what I was talking about before, between them, the April to the March. This is actually 12 months. On February 27th, it was $4.47. That the front month was higher by $4.47, suggesting that there was some convenience to holding inventory. By March 13th, it was $26.72. And if you believed that, well, this will end and the curve will go back either flat or into a more decent level of backwardation, a much more lower, you'd be betting that this spread over here decreases. So you'd make a bet on the spread. This is a tough tough one to play because you have to be right before the expiration of the front contract, which is in a couple of weeks. You'd have to be right. Even though it says April, you cannot hold the futures contract through the delivery period. No broker will let you hold it through the delivery period unless you're registered as a hedger, as either a manufacturer, somebody who either will take delivery or not. You cannot hold it through the delivery period. So you have to be right in the next couple of weeks. I don't think you are. But have a look at this spread over here, the September to the December spread. I'm just going to highlight it over here, the December to the December spread. December 63.84, and the September was 65.27. So you had what, about $1.40 in there as the spread. That's a tough spread to play because you think about that, you go, well, $1.40, is the curve going to get flatter or steeper during this time? Without some idea of any stresses in the market, you got to be a real pro to figure that one out, or you got to be using that for hedging. But have a look at where we are now, and I'm just going to see if I can back up a lot of this ink on the screen. There it is. Okay, and let's do that again. Let's look at the September to December spread. Here you have 76 to 82. So 253, 553, about a little over $6 spread. Now, if you believe that, you know what, this will all be over in a couple of weeks, and that curve is and the price of oil is going to come down. If it comes down, that curve is going to flatten. That 653 is going to disappear and start heading back towards $1 and change. But if you think, no, this is going to be much, much longer, then that spread is going to increase. So now you're making a real bet on the geopolitics and not worrying too much about the direction of the price of oil, because you don't want to be long or short. You want to be neutral oil, but you're making a bet on the convenience yield. So in a case like this, you would short September CL, and you would go long December CL, and you would be hedged. You'd be short 1,000 barrels of oil, you'd be long 1,000 barrels of oil, and you would be short the spread between September and December, making a bet that this is not going to last more than 3, 4, 5 more weeks. That's the bet you're making. The other part of the bet is maybe this goes on, but the Strait of Hormuz will be opened up. Or maybe this goes on, the Strait of Hormuz won't be opened up, but a whole bunch of oil will be released from other areas. The world will find a way around this. Saudi Arabia will start using the Red Sea more and more, and other places will start pumping, and Russian oil will hit the market, and maybe Venezuela can squeeze out a couple 100,000 barrels more, but we'll deal with it. And maybe there'll be some demand destruction, which brings the price down. However you think that will solve itself. The real play is on the spread. You're making a bet on this thing right here, the convenience yield, which the pros play that way. Now, if you're doing this and you're long and you're short, you can use leverage. You can use a lot of leverage because you're going to need, with Interactive Brokers, it's going to say, well, you need margin for this, but this offsets it, so you actually don't need any margin for your oil contract. You just need a margin on the spread, which ends up being very, very low. Very low. Now look at the price difference between this, had you played it. September was up $1.25, so you would be down $1,250 on that contract. But December was up $1.20, so you'd be up $1,200 on that contract. You'd only be down $50 on playing that curve. And right now the spread between the September and the December is super, super wide. That's where the money is to be made. Some people saying, should I buy oil here? Should I sell oil here? It's like, no. Jump over this mess all the way to the fall and ask yourself, is this over? And if you feel, oh yeah, it's over, and you want a low volatility play, then you would bet the spread. And one spread would require very little margin. Now make sure you know what you're doing here. If you're going to do this, that you are comfortable with this. You are playing a curve trade on this one. For those of you who've been through level 3, we've done curve trades in the treasury market. We've done duration neutral curve trades where we're betting on a steepening or a flattening of the yield curve. Here you're betting this yield curve is going to flatten, well, not yield curve, sorry, this futures curve is going to flatten between the tenors of September and December. And you're going to make an oil neutral bet on the flattening of the curve. I'll tell you something, that's where the pros play. They don't play the front month by going, oh, I'm long, I'm short, I'm long, I'm short. They are usually neutral, and they make the safer bet on, will this be over or will this not? Can this spread increase or will it decrease? When you have very high spreads, they never last long. Extreme backwardation never lasts long. Now, let me show you another way this curve can resolve itself. Let's say that you say, oh, it's not going to end, and there'll be no supply that takes over this. Here's what's going to happen with the curve, and I'll draw it out as best I can. Let's look at this top curve over here. Is you're going to get this going on. Well, what is going on between the September month and the December month? From the September to December, it is flattening. So this curve can flatten if nothing happens. Oh, Strait of Hormuz won't be opened. Oil is going to be landlocked for a long time, and there's not enough supply to come onto the market for this. If that is the case and the world sees this as being more regular, that curve will flatten by the longer end of the curve coming up. But if this is over, the spot price will drop, and if the spot price drops, it will drag this whole curve down with it, and it will flatten. The only time, or one of the conditions under which it will actually increase, if you say, oh no, it's going to get a lot worse in the short term, but still be a lot better in the long term. In which case, since your curve trade doesn't expire till the end of August, you'll be okay, right? That is how the smart people are playing it. They're playing the convenience yield. If you want to know more about it, if you have access to the applied level, there is a long reading in sector studies. It's the same reading in trading manuals, derivatives trading for U.S. energy sector, where a curve trade is detailed for you. Okay, let's have a look at SPY. I've got a lot of information on the screen. They're all facts. Every single one of them is a fact except for one number. One number is not a fact. Can you pick out which number is not a fact? It is the forward 4-quarter operating earnings. That is a forecast. That's not a fact. It won't be a fact for another 12 months. Then we can say, well, was it 316? This is the only forecast we have in here. Everything else is a fact. Closing price of SPX, that's a fact, which makes the forward multiple at 20.93 a fact. Last week it was 21.33. Implied volatility, we can observe what the percentile is, and for the last 13 weeks we're sitting at the 97th percentile. The last IV reading we had on SPY was 22.7. Our all-time high, still January 27th, that's 697.16. We are now 5% below that. Those are facts. Here are all the all-time highs for IWM, IJR, and QQQ. Here are the dates on which they hit those highs. Here's the closing prices of Friday. This is the percentage down that they are. Look at IWM. I'm sorry about that plane in the background, but this one has decided that it wants to fly even closer to my house because the pilot with his binoculars said, that guy's doing his video. Bank left, bank left. Anyways. 8.68%. IWM is down 8.68, or 1.3% below correction territory. IJR and QQQ more than halfway towards correction territory. Let's throw some more facts in here. Let's look at the 50, the 100, and the 200-day moving average for IWM, QQQ, and SPY. SPY, here's the 50, 100, and 200, top of the screen. It has lost the 50. It has lost the 100. The 50 is sitting just above the 100. It has not crossed over yet. But we are 0.6% above the 200-day moving average. Will it get support? Doesn't get support, then you're looking at a full correction, which would be 10% down. 10% down on SPY brings it down to 627.44. Look at IWM. IWM has lost the 50, has lost the 100, and is sitting 2.67% above the 200-day moving average, but only 1.32% above the, 1.46% above a correction territory, which means IWM would enter correction territory before it found support on the 200-day moving average. It gets worse when we get to triple Q. It has lost the 50. It has lost the 100. The 50 has crossed below the 100. And the 200 is at 591. It is sitting only 0.45% away from the 200. SPY 0.6% away from the 200. Do they find support at the 200? Or do they break through the 200? Breaking through the 200 sets up a run to the 10% correction. That would bring triple Q down to 571.24. We're at 593, so that's about $23 lower. IWM down to 243. We're pretty much almost there. You can almost call it a correction now. But SPY down to 627. We're somewhere around 662 on the closing of Friday. That is a big move down on SPY. You are talking 350, 400 points on the SPY. That is a big move down. Not unrealistic move either, given everything that we're looking at. Technically, we've got a bad setup. We've got a bad setup no matter how you look at it. The triple Qs rolled over October 29th, usually 1 to 2 quarters before SPY rolls over. SPY has been rolling over for some time. We had this line of resistance we couldn't break. We had this line of support we couldn't break. We are below that line of support, and we are rolling over. Below the 50, below the 100 on all the 3 indexes, sitting just above the 200 with IWM threatening a correction. We do have some earnings this week. Monday is Dollar Tree. Tuesday, Lululemon. I have a long exposure to Lululemon. I am not budging. Wednesday, we have General Mills. I have exposure there. I am not budging. And we have Micron. I have no exposure there, and I'm not budging from that. Thursday, Accenture. That will be an interesting one. Darden Restaurants and FedEx. All right, let's look at some stresses on public markets. There is, I think, a lot of good reasons why a correction would seem to be in order. We just keep layering problems onto the market and then moving on, and those problems are there, and we even hear of them getting worse. Let's just look at everything that we're dealing with right now. What's going on in Iran? This has got a couple of implications. Strait of Hormuz is closed. You have two things going on. You have what's going on in Iran and what's going on with the Strait of Hormuz. They don't have to be solved at the same time, and they didn't have to happen at the same time, but they did. So energy prices just going straight up. But not only that, you do have a war in Iran that was not declared by Congress. That was declared by one man. So for all you students out there with a civics textbook in front of you, if you're looking at the 3 branches of government, flip to the page that has the 3 branches of government, get a Sharpie, and just put a big X through the legislative, through Congress, because it really doesn't exist right now. There really are 2 branches of government, with the judicial being maybe 80% of what it was, right? So that'll give you a better idea of where we are. Cost to the U.S. taxpayer. The idea of solving the debt problem and the deficit problem, that's gone. That is just gone. And the other thing I didn't layer on here is the real potential of having to refund those billion or those $100 billion brought in from tariffs. Good thing it wasn't hundreds of billions of dollars as Trump claimed, but it was only $100 billion. You got to give $166 billion back. You got to give it back. There's the budget deficit gone. Now you're adding $10 billion a week for this war, and that is in the limited capacity that it is now. You're talking about sending in 2,500 Marines, maybe boots on the ground. Be prepared for this to be $100, $200, $300 billion tab that you guys are picking up. That's really mighty gracious of you, but that is a cost to the U.S. taxpayer, because the higher the debt, the higher the interest. Tariffs, 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 and more tariffs. A Section 306, I think it was, investigation on 60 countries have been opened up for unfair or child labor or forced labor. Do you know what one of those countries are? Canada. for forced labor investigations. Canada. I just want you to reflect on that for a moment. Now, if you want to make a case that there is forced labor in Canada in a particular community of immigrants, you're right. There is a case of forced labor going on in a particular community of immigrants in Canada, and it happens in the city of Brampton. So anybody who's familiar with Canada or Ontario will know exactly what I'm talking about, but you can make the case that there is an element of forced labor going on there. But Canada, come on. Anyways, tariffs, and more tariffs. That's going to continue to raise the cost of trade. Not only that, it will eat away more and more and more at the willingness of other countries to import product from the U.S. Negative jobs growth after removing healthcare jobs. You have AI technology disruption. It's hard to make the case that some of these job losses aren't because companies are saying, we don't need to onboard a lot of entry-level people. Let's see what AI can do for us. AI taking jobs, and it will continue to take jobs. If you don't think it is, you're just not using it. Massive capex for AI, so you have free cash flow that's drying up, and if we value markets based on the present value of free cash flow, that just got a hell of a lot lower. What about AI affecting software valuations? Well, that is the market pricing itself, right? So you have to look at the price of different companies in the market and say, well, do they need to come down? That is all hanging out there. The debt that we have, national debt, is already a big problem. The huge cost on debt is a big problem, and you have a Fed that's going to say, we're not going anywhere. We're not going to lower the cost of the debt to the U.S. taxpayer one iota, and if you push us on this, we'll make it more expensive. We'll raise it. The market's already raised borrowing costs on the long end of the curve. You're issuing a 2-year, 5-year, 7-year, 10-year, 20-year, 30-year. You will pay more. That is already an unsustainable path. Put a higher interest rate on an unsustainable path. Put the cost of the Iran war onto a debt that's already at elevated levels, and have a budget deficit that just keeps expanding. You can see where that's going. Private credit stresses. Let's not forget that. That is brewing, and here's the thing is, what effect is it going to have? Nobody really knows. Now, the one thing I will say about this is, even though it's fairly big, it's not 100% of it that's bad. And there isn't a mountain of derivatives on this. So if we let this thing fall, certain people in certain places and certain companies will lose money, but it will end there. The bigger problem with this is that if it affects the willingness of other companies to grant credit. And JP Morgan started that last week, saying no more loans to private credit firms. It's over. Well, maybe those private credit firms needed money to keep supporting their sponsor companies. Now, I know one company in particular is having a little bit of a difficulty figuring out, well, what do we do now? What do we do now? Because it's over. They got maybe a quarter or two, and then it's over. Private credit stresses. That is a big deal. Major equity indexes below the 50, below the 100-day moving averages, and just sitting above the 200-day. There is every reason. Look at this screen. There is every reason for the market to say, you know what? We should price a little bit more risk into the market. Pricing a little bit more risk means a wider distribution of outcomes and typically a lower center of gravity for the market, which means a lower price on the market. So if I had to flip a coin on this one, the coin I think would be weighted towards a further sell-off this week, and probably ending the week at least, if not testing those 200-day moving averages, moving below those 200-day moving averages based on the Fed's narrative on Wednesday. Because Wednesday at 2 o'clock, at 2:30, we get the press conference. If Powell is, we're cautious, we're watching, this is not good. If he strikes a hawkish tone, IWM will hit correction territory. Probably along with SPY and Triple Q breaking the 200-day moving average. By the way, we got a big week in central banks this week. Wednesday morning, Bank of Canada. Wednesday afternoon, the Federal Reserve. Wednesday night, the Bank of Japan. Thursday morning, the Bank of England and the ECB. You have 5 big Western central banks, all within less than a 24-hour period. Canada, US, Japan, UK, Europe. What this is going to be, the commentary on this is probably going to be some of the most interesting, because they all are going to have to address what is going on with energy prices. Japan is going to be a big one because they rely almost entirely on energy coming out of that region. Europe is going to be fairly big. UK will be important. There is an expectation that one of these central banks is going to raise rates. There is an expectation. I think it's time for Canada to cut. I think it's time for the US to cut, but they will not. They will not. If this were going to be Jerome Powell's Fed for the next 2 years, I can tell you this: I never would have made that ZQ bet, because he's not budging. He's not budging, and he's using the wrong lever to fight inflation. You know, it's like using a fly swatter on a table and wondering why the bear behind you keeps attacking. But I'm hitting the table with the fly swatter. Why is it not working on the bear? Wrong tool, wrong direction, wrong strategy.